Hi, today we're going to start Chapter 3, where we're going to learn about journals, the source documents for journals, and recording entries in a journal. The goals of the chapter are to define accounting terms relating to journalizing transactions, identifying accounting concepts relating to journaling transactions and using a general journal, recording transactions in a general journal for insurance, cash, and supplies on account, as well as recording transactions that affect owner's equity. In sections 3-4, we will learn about starting a new journal page and correcting errors in the general journal. First, what we want to know is, what is a journal? A journal is just a form that we'll use to record transactions in chronological order. Thus far, we've been analyzing our transactions into all their debit and credit parts. Now, we're going to try to figure out how do we record all of those transactions in a logical format. And the way that we use, or the way that we do that, is by using a journal. The process of entering transactions into the journal is called journalizing. And then each transaction is recorded in a journal in the form of an entry. We use in accounting the concept of double entry accounting. If you recall, in past chapters we've said that every transaction has at least two parts, a debit part and a credit part. All transactions have at least affecting two accounts, and we've always said that our debits must equal our credits. These are concepts that must be kept in mind when we're talking about double entry accounting. In this semester, we will record our journal transactions into what we'll call the general journal. A general journal is a journal that is used to record any transaction, and it has only two amount columns. It is your most basic journal. There are other types of journals. There are sales journals, purchase journals, cash journals, but we will be focusing on just using a general journal. A general journal will have the page number, a column for the date, an account title column, the document source column, a post reference column, and then our debit and credit columns. When we record our transactions, we will record them using what we call source documents. A source document is just simply some form of paper for which we will use to obtain our journal entry. It is what we call objective evidence. A business must have objective evidence as its source document, some tangible proof that a transaction occurred. A business cannot just make up an entry. They must have some record of the entry actually taking place, or the transaction actually taking place, and we use our source documents to provide that information. When auditors come in and review the books and records of the company, or when the company is audited by the IRS, they must provide that objective evidence to support any transactions that are entered into the books of that business. The first type of source document is a check. It's a business form that requires the bank to pay somebody from the company's bank account. It is the source document whenever we say that cash payments are being made. The check is really made up of two different parts. The left side of the check is the check stub. That becomes your business's record for the transaction. And then the right side, which is the check itself, which actually gets sent to the company that you're paying. In today's world of automated accounting, a lot of the check stub portion is retained in your computer system. But you can see from this check and check stub that in this particular case we paid for supplies using a check number 1, and we paid Port City Supply $275. The information for the check is drawn in the top part of the check stub, and then at the very bottom the amount of the check is recorded, and the balance of the account is brought forward and available for the next check stub. The next type of source document is an invoice. First, an invoice is a form describing the goods or services that are sold or purchased, the quantity, and the price. A sales invoice is a specific type of invoice used to record sales on account. All sales invoices are pre-numbered, and they indicate what actually is the description of the item that was sold. So, as you can see from this invoice, what we have is a sale to Oakdale School for computer network setup for $350, and we know that it's sold on account because the terms are for 30 days. We also know that this is sales invoice number 1, and we know the date of the transaction. Other source documents include, first, the receipt. A receipt is a form that is given as written acknowledgement for any cash received other than for sales transactions. So you'll notice this receipt again is a pre-numbered document. It says who we received the money from and what we received it for, and then it's a partitioned document, and we keep the stub, and then the other party receives their portion as their objective evidence for what they gave us cash for. Next is a memorandum. A memorandum is a form used to describe some transaction that has taken place. There's some brief message that is written on the memorandum, and again, they're pre-numbered items. In this case, we bought supplies on account from Supply Depot, and we paid $500. We have the date, and it's signed by the party who purchased the items. Lastly, we have a calculator tape. This is the source document for daily sales. This is really, in particular, for cash sales. And you'll notice that the date is written on the sales tape, the calculator tape, as well as a number, T12, meaning tape. This is the tape for August 12th. And what this would be is the total of all the sales for that particular day. All the cash sales for that particular day. Now, when we record transactions in the general journal, we're going to go through that same process that we've talked about in the past where we analyze our transaction. We're going to look at what are the types of accounts that are affected, what are their classifications, what's happening to that account, and is it debited or credited. So if we start out with our simple transaction on August 1st, we received cash from the owner as an investment, $5,000. Receipt number 1 is our source document. What are the two accounts that are affected? We know cash is affected and the owner's investment is affected. So we have cash and Kim Park Capital. What is the cash account? It's an asset. What is the Kim Park Capital? It's an owner's equity account. What's the normal side balance for cash is the debit side, and capital, the normal side balance, is the credit side. So what's happening to our cash account? Our cash account is increasing because we received cash. So when we record a receipt to an asset, an increase to an asset, such as cash, our increases to our assets are recorded on the debit side. So we're going to debit our cash, and increases to the capital account are recorded on the credit side. So we're going to credit our Kim Park Capital. To journalize this transaction, we're going to first record the date. When we start a journal, we start out by putting the page number for the journal. So we put page number 1, and on the first line of the page, we're going to put the year 2015, and we're going to put the month, and then the date is August 1st. We're going to enter our debit. Whenever we enter our debits are entered first, and they're always put at the left margin. Our credits are entered second, and they're slightly indented. So we enter our we enter our date first, then we enter our debit. Our cash is going to be debited for $5,000, so we write the account title, on the left, and we write our debit in the left debit column for $5,000. Then we write our credit, slightly indented, for Kim Park Capital, and then we put the credit in the credit column. Lastly, we go back, and the fourth step is to enter the document source, which is receipt number 1, in the doc number column. For the time being, we don't need to do anything with the post-reference column. Next transaction, paid cash for supplies, $275, check number 1. What are the accounts that are affected? Cash and supplies. Both of these are assets accounts. So therefore we know if we've got two asset accounts affected, they're both on the same side of the accounting equation. So therefore one is going to be going up and one is going to be going down. Our assets increase on the normal balance side, which is the debit side, and our assets decrease on the opposite side, which is the credit side. In this case, paid cash for supplies. So we know automatically our cash is going to be going down, and so therefore if our cash is going down, we're going to credit it. If we have to have one debit and one credit, we know that supplies must be going up, so we're going to debit our supplies. And then that would look like this from a journal entry standpoint. We don't have to write the month again because we're staying in the same month, so we'll just put the date of August 3rd. We'll debit our supplies, and we'll enter the account title on the left margin of the account title column, and we'll enter the debit amount of $275 in the debit column. And keep note that we can use either 00 in the cents, or we can use a hash slash mark, and then we're going to use our $275 in the hundreds, tens, and ones column in the journal. Then we're going to credit our cash for $275, and we're going to come back and put our doc source C1. Now let's look at paid cash for insurance. What are our two accounts that are affected? Prepaid insurance and cash. They're both asset accounts. One's going to increase, one's going to decrease. Our prepaid insurance is going up, so we're going to record a debit to our prepaid insurance by putting it in the journal in the left margin. We're going to put the date, the 4th, the prepaid insurance, and then the debit amount. Then we're going to enter our cash because we're paying it out. We're going to decrease our cash. And then we're going to record our source document as check 2. Now we're buying supplies on account. Whenever we buy supplies on account, we have one asset account, supplies, and one accounts payable account, which is a liability. So on August 7th, we bought supplies on account from Supply Depot, $500. We recorded that transaction on memorandum number 1. So if we've got supplies increasing and accounts payable increasing because it's a liability on the other side of the accounting equation, we're going to debit our supplies and credit our accounts payable. First thing, enter the date, August 7th. Then debit your supplies in the account title column and the debit column. And then record our accounts payable increase by recording a credit to our accounts payable because its normal side balance is a credit. And then lastly, we're going to write the doc source number M1 in our doc number column, step 4. The next type of transaction is when we actually pay down that accounts payable. We're going to say that we have the accounts cash and accounts payable affected. What's happening to my cash account? My cash account is going down. What's happening to my accounts payable account? It is also going down. I do not owe as much as I used to because I'm paying it off. My cash is an asset account and my accounts payable is a liability account. So the normal side balance for my accounts payable is the credit side. So therefore, if I'm decreasing my accounts payable, I'm going to debit my accounts payable. And if I'm decreasing my cash, I'm going to credit my cash for $300. This will look like this in your journal. On August 11th, I record my date. Then I record my debit to my accounts payable. In the account payable accounts title column, and then I record the debit of $300 in the debit column. I then record the cash credit by slightly indenting the cash and recording the credit of $300 in the credit column. And then lastly, I put my document source number. Now we move on to section 3-3, where we're going to be recording transactions that affect owner's equity received from sales. And we will listen to this discussion in our next segment. So thank you. And continue to your work together problems for 3-1 and 3-2. Thank you.